Of this two-part series on search-based financial markets. Just want to take the extra opportunity to thank Elkanan and Eric and Ilana, who's standing outside, and all the other people that made this possible. And I think of it as a real privilege to be able to be here. I was here, I don't know, Eric and I were discussing yesterday how many years ago. I think it was around 14 years ago. In a previous version, that would make it whatever the 16th summer school. And while I was here, I met a student, Lasse Heyer Pedersen from Denmark, who that fall entered our PhD program at Stanford. I hope he was enriched by the school. For that or other reasons, he became a superstar financial economist. And today he's back in Copenhagen. Doing fantastic work on financial economics, including models of markets with frictions, which is one of his specialties. And I'm going to talk about the joint work that he and I and Nikolai Gerliano did in our first segment today, and in the first part of the first segment. And if we have time, I'll go into the second application of search-based markets, in which an infinite number of investors are intermediated by a small finite number of dealers, which is a different model than the one that we discussed yesterday. Before we do that, are there any discussions, any questions, comments, concerns? Okay, now I was very pleased to see that quite a number of you supplied solutions to the homework assignment, optional homework assignment that I gave you yesterday, which is to compute the steady state distribution of investor types in the model that I described yesterday, in which investors are either buyers, sellers, or inactive. And when a buyer meets a seller, they trade and both become inactive. And an inactive trader can become active at some mean rate eta. And in the base model, I took it to be equally likely that when becoming active, you would be a buyer or a seller, and we showed these dynamics at the bottom of the page. And I asked you, what are the stationary distribution, to put it more correctly, for this model? And many of you provided complete, accurate solutions. Is Dwin here? Yes? Okay, so you provided one of the complete, correct solutions. Do you want to just briefly describe? You don't have to come to the board and provide all the algebra, but just briefly describe what happens. Speak very loudly, please. Or if you like, come to the front and use the microphone.
So we have these three equations. So in steady state, we would expect the three types wouldn't change over time. So I set the derivative of each type to 0, and I get three equations, and plus the equation that the three types add up to 1, and I can solve this system of equations to get the results.
Correct. And then what did you discover about the solutions?
So one, the non-active agents have equal probability to change to sellers or buyers. I get like infinite number of solutions.
For the steady state?
Yes. And one, the probability is unequal. Like it's more likely to change to sellers than buyers. I would get degenerate results. That is, the fraction of sellers is 1. Or the fraction of buyers is 1.
Yes. Okay, that's completely correct. And let me say a little bit more, because you discovered more than you just told. You discovered that in the case shown, where it's equally likely to become buyer or seller, if you look at the symmetric steady state, you got a nice little quadratic equation for the solution. These equations in general are called algebraic Riccati equations. And this is a particularly simple case. We'll see another one in a few minutes. So in the symmetric case, you're solving a quadratic equation, which is very simple for the equal distribution of buyers and sellers. And picking up on a comment of Gore yesterday, we wouldn't really expect the asymmetric case in steady state in a more natural economic setting, where there happen to be, let's say, more buyers than sellers in the steady state. That doesn't seem very stable as a stationary solution for this market. We would expect something in the model to change so that if there was an excess of buyers over sellers, that your propensity to become a seller would somehow increase, either through additional search or a change in the mutations. So that's not a very stable solution. The symmetric one is somewhat more stable. And as Drinjwin pointed out, in the case where there's an excess of one type created over another, there's actually no interior solution. If you start the model with all buyers, it will stay all buyers forever. If you start the model with all sellers, it will stay all sellers forever, which is degenerate, not that interesting. Okay, so we're going to go to this morning to add some more economics to this basic search and matching model. So I'm going to page way ahead to where we left off yesterday, unless there are questions. As I said, a number of you, yes, Idan.
Suppose there is a case where there are macro shocks and this mu n sort of becomes more buyers or more sellers, something like that. So you're saying that if this macro shock, if there are no macro shocks after that, then the market is going to be degenerate.
That's right. In the model that I'll describe now, I'm only going to give you the stationary solution for today, but in our paper, if you care to have a look, we look at the case of a macro shock that disturbs the equilibrium number of buyers and sellers, and we examine how the price jumps for the asset and then how it eventually recovers as investors find each other and look at the opportunity to trade and then converges back to the steady state. So here we go. We've got an hour and 20 minutes, so let's enjoy our time together. And I'm going to pose questions to you if you don't pose questions to me, so we keep this lively. Any questions before we start? Okay, this time, actually picking up on one of Eric's comments, we really need four types to make this model, this Eric's comments. We need four investor types to make this model interesting from the viewpoint of asset pricing. So we're going to have agents who have a preference for the asset, which is either high or low, meaning they like owning the asset or maybe not so much. So in the housing market context, people are really enjoying owning the home as opposed to renting, as long as they're a high type. A high agent gets full flow value per unit of time, 1 unit, without loss of generality, from owning the asset, whereas the low type only gets 1 minus delta, where you can think of delta as some disutility for owning the asset. A high type agent that is somebody that really likes the asset can switch into a low type agent. This is the mutation intensity, which is called Ku. It's one of those eta coefficients that we had yesterday. And then the opposite transition intensity for a high type becoming a low type. Sorry, this is obviously a typo. A high type becomes low with Kd, and the opposite transition intensity is Ku. And then agents are matched, as we had yesterday, at some Poisson arrival intensity lambda. And when they meet, and that's going to be the focus today, they're going to bargain over the price at which, if an agent that wants to buy meets an agent that has the asset and wants to sell, they're going to bargain over the price. So that means there's altogether 4 types of investors today. There's somebody with a high preference that already owns, let's say, a house, somebody with a high preference that doesn't own the house, that's a willing buyer. Somebody with a low preference for owning the asset that does own it, and that's going to be a willing seller. And then low type preference that doesn't own the asset. So you get the 4 types. It's a 2-by-2 situation. Any questions about the type space? Okay, and like yesterday, we'll call mu sigma the fraction of the agent population of a given type sigma in this type space S. Okay, the next thing we need to do to talk about market clearing or asset pricing is to discuss the total supply of the asset, which is some fraction of the total number of agents. So S is the per capita amount of the asset available to the market, and which in particular implies that the high preference owners and the low preference owner masses have to add up to S. Any questions about that? Okay, so now let's, yes, Idan, go ahead. Okay, that's exactly what we're going to do, and we're going to do it in 2 steps. First, we're going to assume that any trade that's efficient when a buyer and seller meet is actually going to happen, and that will turn out later to be true in equilibrium. And then given that, we're going to be able to solve, just like you did for your homework, the fractions of the population of each type, and we'll do it in the steady state. And then, only then, we will be able to examine the bargaining problem for when a low type owner, that's Eric, who therefore wants to sell, meets a high type non-owner, that's Lutz. It means he's looking for the opportunity to buy. He doesn't own it now, but he has a high preference for owning. And when they meet each other, they're going to bargain over the terms for trade. We're going to use a Rubinstein style bargaining problem, and they'll agree on a price instantly, because that's what happens in that style of bargaining game. No, there's no central marketplace. So this is the whole idea of search-based bilateral trade. There's no central marketplace. That's a good question. Any other questions? Yes, Gur. We are. And in answer to an earlier question by Idan, the analysis that we did includes the dynamics of price movements as the population sorts out the reallocation of the asset when it's not already in a balanced state. But there's no need to impose no arbitrage, because here the opportunity to arbitrage is essentially non-existent. There's no exchange at which you can say, aha, the asset is trading at too low a price, so I'm going to buy it and do something else. You could. That's right. So you're exactly right. Here we're only looking at a bilateral search model where there will be opportunities, I forget your name, I'm sorry, for Rachel to step in and say, wow, we're missing an intermediary here. I could step in and arbitrage by immediately buying from Eric and selling to Lutz. And so that's an entry situation. And if Rachel had exceptional search ability, or she could simply post a sign that everybody could see saying, I'm making markets for buyers and sellers, come to me, then she will capture all trade. In fact, in the econometrica version of this paper, which I'm not doing today, we introduced Rachel and we examined what that did to the terms of trade, and she ended up capturing 100% of the intermediation rents, and all of the trade came through Rachel. And later today, we'll talk about what if there's multiple dealers. So you're forecasting what's coming up. Okay, so now I'm going to get your help with, this seems like it might need a battery. Is Daniel around? Okay, well. Let's revisit the equation now for the dynamics of the masses of each type. And since we already did this in a very simple setting yesterday, I'm going to actually go to you Is Alexei here? Alexei, okay. So help us interpret the rate of change of the mass of agents who have a low preference for owning the asset and actually already own it. So this is our Eric type. He sits in a house. He's not particularly anxious to own a house anymore. He's a willing seller, and we want to look at the rate of change of the mass of the agents of that type. So can you take us through, let's say, the first term of this equation? So how do you unravel that, if you would?
So the mass of those high value and low value, right?
Yeah, that's mu hn. That's the Lutz type.
So the chance means those who have low type you own, right? Multiplied by chance of trade happen.
Yep.
So this is how the number decreases with mu mean, right?
Okay, so let's go more slowly so that people who didn't do the homework like you did can follow along. So this is, again, Eric's type. He's going to meet somebody with intensity lambda. And when he meets somebody, the probability that they're of a willing buyer type is the fraction of the population that are willing buyers. Those are the high preference types that don't own the house already. So this is the mean rate at which Eric is going to meet somebody with whom he's going to trade and no longer be an owner of a house. So that's his mean meeting rate. This is the mass of people like Eric. So the total mass rate at which the population of low owners is going down is given by this expression here. Does everybody get that? That's really important. Again, if you're going to develop a model like this, you really need to get that first term, because that's the interaction term. In physics, that's called the collision term. This is a version of the Boltzmann equation for those of you that do physics. That's the collision term between the masses of two types. Okay, who wants to take a whack at the next term in this equation? It's actually much simpler. Eric, you want to try this? Speak very loud, please. That's the mean rate at which each of them switches type, and times the mass of them. So that's the total population mass rate at which you're losing this type because they're switching types and they're no longer going to be a low type. Yeah, that's a typo. That should be KU. Thank you. It should be KU. And then this is just the analogous immigration term. This is the... no. This is the immigration term of the... okay, it's working again. I just didn't turn it on, huh? Operator error. Okay, so this is the immigration term for the high types that own a house, and all of a sudden their preference changes and they become a low owner type. And that occurs at this intensity KD. Okay, so that's the first term in this system of mass equations. And then there's, we're not going to go through them, there's the analogous terms for each of the other types. Now we have a system of 4 differential equations and 4 unknowns, which is an ordinary differential equation. Started off at any initial condition, and it will evolve uniquely. And we're only going to look at the steady state case like you did in your homework, which in this case does turn out to be the limit solution of this differential equation. In fact, it's the unique limit solution in this case, as opposed to your homework situation. And it's invariant to the initial condition. So it's very determinate. This is what I'm saying is a very determinate situation. And if you wanted to, you could also analyze the non-stationary case, which is quite interesting because it gives you the speed with which the price will recover if you shock the market. That was a question that both Idan and Gur were interested in a few minutes ago. Okay, so now that we have the mass equations, conjecturing that whenever Eric and Lutz meet, they will actually trade, we're going to calculate the price at which they trade and then confirm that they will trade at that price. So these mass equations will turn out to be justified in equilibrium. So it's a two-step procedure. In a more elaborate model, which has also been solved, Eric and Lutz can speed up by making an effort the rate at which they try to find each other or other types that will be willing to trade, and you'll get an endogenous solution to the intensity of search, and you get some interesting effects from that as well, but we won't have time today for that. Okay, now the preferences, we're going to make them very simple, linear preferences for cumulative consumption. So this is any agent, let's say Lutz's cumulative consumption. It's going to jump up whenever the house is sold, because they're going to be able to consume the sale price. And it's going to jump down whenever the home is purchased, because that's going to be a sudden reduction in cumulative consumption. If you don't like that idea of negative consumption, it's equivalent to just store the money in a bank account at the interest rate. So that's one source of consumption, is the purchase and sale. And then there's another source, which is when you're in the home, you get the benefit of owning it at the rate 1. If you're a high type owner, at the rate 1 minus delta if you're a low type owner, and not at all if you're not an owner. So that's the service consumption associated with being in a house or not. And we're going to calculate Lutz's utility for lifetime consumption discounted at the rate R. And we're going to solve for this utility function, and that will give us some more equations, and then finally we'll solve the prices. Okay, everybody ready? Any questions so far about why we're here, why we're doing this? What are these symbols? Are we really going to solve this system of equations? Yes. Okay, so here's the reduced Hamilton-Jacobi-Bellman equation. How many have seen HJB in their life? Oh, that's excellent. Almost everybody. Okay, so it won't take too long to go through this. We're going to calculate, let's say, low owner. That's Eric, because he owns the asset. He doesn't really care about owning it that much. We're going to look at how his utility solves an HJB equation based on the time preference rate R and based on the mean rate of gain for Eric given his current type. And that's what we're going to go through, each of the terms in the equation. So this is the basically discount rate multiplied by value. So this is basically the time preference effect on his value. Let's put that aside. The HJB equation says this time preference effect must be equal to the mean rate of gain that he has for his current status. And that comes from a number of terms. The first one is easy. If he's a low type, it could happen at rate Ku that he'll suddenly enjoy being in the house, and his type will switch to that of a high owner, which is nice. And so when he switches, he'll switch out his utility from being a low owner to a high owner, experiencing this gain, and this gain occurs at this rate Ku. Does everybody get this first term in the equation? By the way, is my voice heard in the last row? Am I actually being too loud? No? Okay, good. Okay, let's ask one of you to interpret the second term, and I want you to interpret it as a mean rate of gain for doing something. Patrick, you want to give this a shot?
Okay, so I think this is the interaction because
Hey, Jose, good morning.
because we see well the rate with which our agent the counterparty is willing to trade.
Okay, that's perfect. That's this first factor here. So let's break that down. This is the mean rate at which Eric is meeting somebody, and the probability that he meets somebody with whom he is willing to trade is the probability is the fraction of those types which are high non-owners like Lutz. So that's the total mean rate of arrival of a trade occurring for Eric. Okay, continue.
Exactly, and then he gains the price.
That's right. He gains the price, and then?
And he loses his utility of owning.
Yeah, he's no longer a low owner anymore, so he loses that indirect utility.
But he gains one of the non-owner.
And he gains the utility of being a non-owner with a low type. Exactly right. So this is the mean rate of trade times the total gain from trade, including both the direct price effect and the indirect effect of changing from an owner to a non-owner. This is a very good opportunity for anyone to ask. Okay, who wants to take a shot at the last term? Volunteers. It should be minus a rate of gain of something. It's too easy, so you're all embarrassed to raise your hand. Go ahead. Not Patrick, because we already called on him. Anybody? Yes, Jan. Precisely. So this is the flow rate of gain of sitting on the asset. Although he doesn't get the full utility of being a high type owner, he gets the reduced utility of flow utility of being a low type owner. Okay, so that's the HJB equation. You're familiar with having some sort of maximum going on, but we've already substituted in our assumption that when Eric is presented the opportunity to trade at the price P, and he has a 0-1 decision, trade or not trade, he's going to agree. So we substituted that in because it's the best thing for him to do, which will turn out to be right in equilibrium. The R is the time preference rate. So this is so-called Martingale condition. If you take discounted indirect utility plus the sum of discounted gains, in expectation that must be a martingale, and now take the drift of a martingale to be 0 and apply Ito's formula, you'll get this time preference rate times indirect utility, which you can think of as a penalty for basically having an indirect utility of size V when your time preference rate is R. Okay, so that part is the typical HJB term, and this is the rest of it. And if we had some sort of diffusion going on, there'd be a second order term, but there's no diffusion in this model. Yes, another question. Nikita.
Does this mean that we're equating the value of holding the asset at the low side with the value of getting rid of it?
No, this means that Eric is standing here today and he's calculating at what rate am I expecting to benefit from being a low owner. And that's all of these terms with a minus sign. And that must be equal to my time preference rate times my type value. It's a little bit different than what you just described, but maybe you have it in mind. Okay, so that's for Eric's type. There's an analogous equation for each of the other three types. So now we have 4 HJB equations in 5 unknowns. There's 5 unknowns here, which are these indirect utilities. We don't know them, and we also don't know the price, P. This is not so good. 4 equations, 5 unknowns. We're missing something. We're missing an equation that determines the price at which Eric and Lutz agree to trade. And that's coming next. Notice that these equations are linear with respect to these 5 unknowns. So we have a system of 4 linear equations in 5 unknowns. And for those of you that are getting ready to write your first research papers, here's a recommendation that I always give to my own students at Stanford. Don't simply throw in whatever ingredient for price determination that first comes to your mind and then struggle with it. Make it easy on yourself. You know you really want to have a linear equation for price, because then you're going to have 5 equations in 5 unknowns linear. So it's not cheating to make the model simple to solve by picking from the array of economic concepts at your disposal one of them that's plausible and natural and will give you a nice, easy solution. Or another way of saying it is, it's not cheating to start with a boundary condition of tractability and work back into the model. The test is whether when you're finished, your model is natural. Okay, so that's a trick on model development that you'll all eventually learn. If instead you just take all of the ingredients that first come to mind and you put them in and try to stir them around and solve it, you might end up with a big mess. So in this case, the first thing that comes to mind that would be a linear equation for the price is the Nash bargaining solution. And we're going to do that for just a minute or two. And there's two ways to do it, as I mentioned yesterday. One is Nash's 1950 axioms, which are things like the independence of irrelevant alternatives, symmetry, Pareto efficiency, things like that. I think in the interest of time, I'm going to skip over the Nash bargaining solution, which is, let's say, axiomatic, and go directly into a bargaining game setting that was set up by Darrell Rubinstein, because I find it a little bit more persuasive. Okay, so that's what we're going to do. So but here's how it's eventually going to go. Here's the jump in indirect utility that Lutz will experience when he goes from being a non-owner to an owner. Here's the jump in utility that Eric will experience when he goes from being, that he would experience, that he's going to give up from being an owner to a non-owner as a low type. And whether you take the axiomatic approach of Nash or the extensive form bargaining game plus limits, you're going to end up with the price being a weighted average of the two gains from trade, or outside option changes in value, where the weights are given by relative bargaining power. So here, without loss of generality, the weight on Lutz's type is called the bargaining power of the seller. That's how much weight is placed on that. So if Eric, who is the seller, has full bargaining power, Q equals to 1, he'll extract full rents from Lutz by making him a take it or leave it offer, effectively. And in the opposite case, Lutz will get a great deal by buying the house at Eric's reservation price. Okay, so this is the there are two approaches to bargaining that will give us this price, and I'm going to go through only one of those two. Any questions before I do that? Yes, Lutz.
Now, change basically one function for one just parameter. Are there like on the empirical side, what would be empirical properties of bargaining power in the
Excellent.
or
Excellent. So in the bilateral continuum model, it's a little bit trickier because we don't have a lot of structure to go on. And when you don't have a lot of structure and the model is relatively symmetric, you might say, 50-50. But in the case that we're going to do next, where there's a finite number of dealers, the people in the front row, they, in practice, the bank dealers in practice are making take it or leave it offers, except to their very largest customers who have some bargaining power. And so then we would act accordingly. We would give all the bargaining power, or most of it, to the dealers. Your name, sorry? Tomio. You could. And in fact, there's a really nice extension of this kind of model by Ricardo Lagos and Guillaume Rocheteau, in which we're not talking about a one-unit asset like a house, but something more like treasuries. And it'll turn out that in the most natural version of that model, they'll split the quantity of treasuries that they own between them in a symmetric case. So if Eric has a lot of treasuries and Lutz has some but not a whole lot, they'll each come away from the bargain by withholding the same number of treasuries between them. And so that's a really nice extension by Lagos and Rocheteau. And there are other extensions as well. Okay, so now once we fix the bargaining power, which can happen, I'll describe How that happens in a minute. We already talked about that. We have 5 linear equations and 5 unknowns. And for any q, you can check that this is actually a non-singular system of 5 linear equations and 5 unknowns. So there's a unique solution, and we're pretty much done, except for writing down the solution. Any questions before we do that? OK. So I said I'm going to skip over the bargaining solution of Nash, 1950, and go directly to the Rubinstein alternating offers game, which I find a little bit more interesting. So let's suppose that Lutz is the first person to propose a price to Eric, and he says, how about the price P, $1 million for the house? And then Eric can say, OK, and then they trade at the price P. This is the extensive form game. Or Eric could say, well, I don't think so, but not ruling out the opportunity maybe for a reoffer by one of them. OK, everybody there so far? So in this extensive form game, if Eric rejects the offer, there's going to be a chance, in the way that Rubinstein sets it up, there's actually multiple ways to set up this game. There's going to be a chance that something will go wrong and they'll lose the opportunity to trade. One of the things that might happen is, in the short period of time during which this game is going, one of their preference types changes. Right? All of a sudden, Eric has a mutation he likes. Now he likes living in a house. He says, sorry, Lutz, actually now I think I like my house. I'm not interested. So that's one of the ways that a breakdown could occur. Or Lutz could say, I'm not interested in buying anymore. Or other things could happen. In the Rubinstein game, this is just kind of an exogenous event. And with probability phi, there's a breakdown, and everybody stops, and then they go search for other counterparties if they're still interested in trade. With probability 1 minus phi, we're going to have another bargaining opportunity. And in this case, the way that it's drawn, Eric will have the chance to propose a price. It might be a different price. And then Lutz can agree or disagree. Eric.
It looks as though the way you set it up, bargaining does not occur in real time.
Great question. So the way that we cheated a little bit in the paper, because we have this continuous time model of the market is moving, preferences are changing, and then we have a little timeout. We're a very short period of time. This whole extensive form game is happening with some steps. And what we actually do in the paper is we make the length of the time steps go to 0, pretty much actually like Rubinstein does to get a unique price solution. And we kind of imagine that this bargaining is happening in a very short period of time. And in the limit, the time preferences play no role. But there is, let's say, the opportunity to break down, and that actually affects the price in the limit price, it turns out. Question from the back.
Yeah, just to understand, you said P minus 1 minus P is equivalent to transfactor and
It's yes. There's a similar version of this where there's a time discount associated with delay. Here, the effect of not agreeing is you take a chance of breakdown, and there's another form of this game where there's a different time preference effect, and that's kind of messes up our story, so we don't do that one. Actually, we do both, but the one that I'm going to describe is the simplest one. So here's the proposition, which is basically a restatement of a result by Binmore, Rubinstein, and Walensky. As this probability of a single-step breakdown converges to 0, the prices that are offered by the buyer and the prices that are offered by the seller converge to a unique price, which is the solution of this maximization problem, which is equal to the Nash solution for equal bargaining power. Okay, so that's very nice. Now but Binmore, Rubinstein, and Walensky integrated an extensive form bargaining game with the Nash axiomatic solution. And we have our price. And let's see what it looks like. Well, we can actually enrich in the model by saying instead of making it 50-50 who proposes, we can start the game by the seller proposing with probability Q first. And you get same idea, slightly more general, with more bargaining power for the seller. Once you do that and you solve the five linear equations and 5 unknowns, out the end of the algebra comes this nasty looking solution, and I'm not going to talk about it in detail, but I'm going to give you one or two properties of the solution, and then we're going to move to the multi-dealer game. Anything before I do that? Any questions? So now we have a determinate solution for this game given all the parameters. Let's just look at, from this paper that I did with, again, Lasse Heyer-Petersen was one of you 15 years ago, and Nikolai Garlianu, who's now at Berkeley. We wrote a series of papers on this sort of problem, and this is one of the results. Let's skip over the first result because it's just very natural dependence of the price on preferences and mutation rates, and go to the effect of increasing competition in the market associated with faster and faster search. In that case, the price converges to the present value of owning the asset in a perfectly competitive market. Okay? Then, provided the separate result, and this is for those of you that are interested in the effect of search on whether the price is above or below the efficient price, as the provided the search intensity is above some constant, which I'm not going to tell you about. This is kind of interesting. If the supply of assets is small enough that in a perfect setting we could give all of the assets to high-type owners, if that were the case, then increasing the search intensity will raise the price. Let me interpret that. Again, suppose in the perfect allocation, all of the homes would be held by people that really want to live in homes, if that were the perfect allocation, which we can get if lambda goes to infinity. In that case, if we increase search frictions, the prices of homes is going to go down. Price of homes will decline. On the other hand, if we have more than enough homes to meet the desires of all the high-type owners, and in a perfect allocation, the marginal investor is a low-type owner, then adding search frictions will actually increase the price of the home, which might be a little counterintuitive for some of you. For a finance person like me, it reflects what are called specials. So there's a situation in treasuries markets and other bond markets and actually securities lending markets in which, because of search frictions, there's not enough of the asset to go around quickly enough to meet the needs of those who really want it. And investors are willing to pay extra in order to get access to the asset. It's trading on special. How many of you have heard of specials in either the sec lending or repo market? Oh, not so many. Okay, so that's a very interesting phenomenon. So search frictions can actually increase the price of an asset if there's not enough of it to go around. Okay, so please don't get the impression that adding frictions always drops the market value of an asset. It can go either way depending on, depending on the supply of the asset. Right. Okay. Excellent point. Let's elaborate. Can you tell me your name? Gregor. Gregor has made an excellent point. Here, we only have low-type and high-type owners. And so there's really only one interesting bargaining situation, which is when the Eric type meets the Lutz type. And adding search frictions will either cause the asset to be, in excess supply or excess demand in a search sense. What if we had an intermediate type? So instead of having low and high, we had an intermediate type of owner. Tell me how many different prices we need to solve for. in this model. Again, we have 3 preference types rather than just 2. With only 2 preference types, there's only one price at which trade occurs, and that's when a low type meets a high type. What if we had 3 preference types, one more preference type? Then, how many prices do we need to solve? 3. Correct. Which are? That's right. And actually, this goes back to, where's Nikita? Nikita asked a question yesterday to Yaroslava about the fact that in a exchange-based market, there's a unique price that clears the market. And I think the sense of Nikita's question was, if we had some kind of friction in this market that prevented everybody from meeting at the same time in the same place, could there be multiple prices? And yeah, search frictions will result in what financial economists call price dispersion. The same asset on the same day will trade at multiple different prices because there are different pairings of agents whose bargain will result in different terms of trade. So it's a strict violation of the law of one price. No opportunity to arbitrage it. And it's not called volatility. It's not about the price moving up and down intraday. It's about the fact that there are different matches that will generate different pricing terms because no one is able to arbitrage across the whole market at one point in time. And now coming back to Gregor's question, if we had many, many types in the market, we would expect many, many prices. And as the search intensity goes to infinity, we would expect all of those prices to converge to the Walrasian price associated with perfect markets. Yes.
What happens if I know the mass of people that are from each type, but when I meet someone, I don't know which type. Then
Okay. Yeah, very, very interesting question. So Eric meets Lutz, but he's not sure what Lutz's type is, and it's not printed on his shirt. In this model, it won't matter because there's only 2 types of preferences. But if we had 3 types of preferences, now Lutz has the advantage of claiming that he's not of the highest type. He's really only a medium type, and he's going to try to, everyone is going to try to pool with the medium type when meeting the low type if we actually knew that Eric was the low type, and we get all of this problem with incomplete information, and it's kind of a mess. So in our model, everybody has a label on their shirt, if you want to think about the multi-type version of it, that says, I'm a medium type guy, because I wear a black shirt and I'm in Jerusalem today, so you know everything you need to know about me. That's a very good question. Yes, Nikita.
I was wondering if there's a version of this model where when during Nash, they stay together in the same time frame as the market. So they stay together for some length of time.
Yeah.
And in this length of time, they have some rate at which they can make everything over.
Yeah. Yeah, there is a paper that does exactly what you just discussed. And I'm going to try to remember the young researcher that did this a few years ago. He was on the job market from the University of Montreal. He went to the Einaudi Institute, and now he's moved again. There's some people here from Einaudi. Do you know who I'm talking about? No? Okay. Anyway, someone looked at that, and you get this massive system of equations that he solved. And very impressive. Alluding to a comment from Eric a few moments ago, we're cheating here because we're taking our bargaining encounter to be of a shrinking period of time and taking the limit zero amount of time necessary to conduct the bargain so that we're avoiding that difficulty. But we are considering, as we do that limit, that during the discussion between Eric and Lutz, one of their preference types might change and they're going to lose the opportunity to trade. We're allowing for that. That's reflected in the price formula that you saw. He went first to the Einaudi Institute, and now he's moved again. It's associated with the Central Bank of Italy, the Banca d'Italia. And I'll look up his name, just ask me after class. I'm really embarrassed that I can't quite remember it. Yes. I forgot your name, I'm sorry. Yes. That's right. That's a really good question, and let me tell you how the theory developed. The theory developed by taking all of the outside option effects. Let's go back to the beginning. All of the outside option effects are reflected in the indirect utilities for missing out on the opportunity to trade and not collecting this change in value. And then controlling for those outside option effects, how are the terms of trade going to be split? So there's each of them has a gain. In principle, one of them could extract the reservation price of the other, and if the bargaining power will settle what fraction of the relative gains from trade is going to be reflected in the price. So that's basically an additional effect on top of the outside option values that you just described. Yeah, that's a very good question. Okay. Now, I'm going to jump into the last, this is my last opportunity to talk about search-based asset pricing. Now we're going to go to the situation where there's a designated number of dealers who have emerged to make markets. And we discussed yesterday how that might happen. For example, in some work by Qiaojun Wang, that some of the people in the room will say, oh, like Gore suggested, there are opportunities to cut through some of these search frictions, get some rents associated with being a dealer. I'm going to open my business as a dealer. So Goldman Sachs started in the middle 1800s by dealing, and that's now my job. And so they're going to set up business. We're not going to talk about entry today. We're going to talk about a designated set of dealers, finite in number, and how the terms of trade will depend on, specifically today, price transparency. That's going to be our focus. So you'll learn two things. How do you set up a multi-dealer market? And one way to do that, which is based on a model of Stahl in 1989 from a different literature. And then in a multi-dealer market, how does changing the price transparency affect the terms of trade? Price transparency in practice in finance comes in several forms. So I'm going to only do one of them, but I'll talk about all three briefly right now. There's called pre-trade price transparency, which means we have Jose, we have Elkanen, we have Eric. They put up a screen saying, if you find me, here are my prices. They're available for anyone that wants to look. That's called pre-trade price transparency. Okay? Post-trade price transparency means a few moments ago, Eric found Jose. They conducted a trade, and that trade was reported publicly. Now, in the stock market, it's called a ticker. In the modern swap markets, it's called a swap data repository. It's actually mandated by regulation now that over-the-counter derivatives trades must be publicly reported in order to give all of you investors an idea of what the current going price is. So that now when Lutz calls Elkanen and asks for terms of trade, and Elkanen knows that Lutz saw the price that Eric and Jose conducted, it's going to be common knowledge between Lutz and Elkanen that Elkanen better give him a price close to the last observed price. Otherwise, Lutz will say, I'm not getting a good price. I'm going to keep searching. I'm going to call Jose or Eric, and that will discipline Elkanen's bid-offer spread. Everybody get this idea of post-trade price transparency? As you add post-trade price transparency, the buy side, which refers to investors that are not dealers, are better informed about the going price, and that will get them a better bargain And we're going to model that in a second. Okay, great question. Great question. So in practice, price and quantity, but no identities. So we won't actually learn that it was José that gave the price to Eric. And so we won't be able to use an effect that actually Lutz described yesterday, which is the discipline on the market of José giving bad prices will not be identified with José, so he won't suffer any reputational cost. But the quantity of the trade and the price will be reported with an important exception. If the quantity is very large, in practice, the quantity is not reported. It's only reported that it's above a medium-large cutoff value. In a search-based market, why might you think that would be important to cut off the reporting of a very large trade that just occurred in which José just bought a ton of treasuries from Eric? Why wouldn't we want everybody to know that right away? Eric? Because? Right, great. So for those of you that didn't hear Eric's answer, which was right on the mark, if it were public knowledge that José now owns a huge stack of treasuries, the next time anyone wants to trade with José, or José calls anybody to trade, everybody would know. He has a stack of treasuries a mile high. Clearly he wants to get rid of them. He's in a very bad bargaining position. So he's going to get exploited. And going back to the original bargaining between Eric and José, José is going to offer Eric a bad price because he knows he's going to end up in this situation of everybody knowing he has a stack of treasuries that he has to get rid of. So the market has arrived at the convention, or by regulation has arrived at the reporting convention that very large quantities are not fully disclosed. That's a long answer. Nikita? We don't know the identity, but we know that a large trade just went off. And if José is now going to try to lay off this trade with somebody else, we're going to infer it's probably because he just was the dealer that took that position. So here, the finite number of dealers also plays an important role. Okay, here we go into this model, and we're going to talk about a limited form of post-trade price transparency, which is called benchmarks. A benchmark price is the average price that exists in the market, or it's the average cost of dealers for obtaining the asset. So an example is LIBOR, which is the interest rate at which the largest dealer banks are negotiating large loans in a given currency, like dollars, for a given maturity, like 3 months. And as you all know, or many of you may know, LIBOR is a problematic benchmark. It's being replaced by new interest rate benchmarks, but that's not the topic for today. Okay, so that's one example. But there are almost every actively traded market has a benchmark that's reported, but not all. And we're going to talk about the advantages of that. Pre-trade platform-based price quotations is another form of transparency. Benchmark price reporting and post-trade price transparency. We talked yesterday about the corporate bond market. The paper I mentioned by Asquith, Covert, and Patak has a wonderful empirical analysis of introducing post-trade price transparency into the corporate bond market and what that did to price discovery and market efficiency. That's a 2013 paper going through a multi-year revision, and when it comes out, it's going to be the benchmark in the literature for post-trade price transparency. It's an amazing paper. I'm going to skip over, mention that there are price benchmarks for many markets. By the way, most of these have been manipulated. Why? Because, for a lot of reasons. Let's not go into that now. It's a whole different story. We're going to skip over the LIBOR market, and we're going to talk about the welfare implications of providing price transparency. And this actually applies to all forms of price transparency. And then we're going to give a model that delivers these welfare effects. And this work is based on a paper that I wrote with Piotr Dvorak at the Northwestern University and Haoshang Zhu at MIT. Any questions before we launch? Okay, so we've got almost half an hour. Let's take full advantage. And you're going to learn some new methodology as well on how to search in a dealer-oriented market. Okay, so what does price transparency do for welfare? Well, it's going to increase the beneficial volume of trade. It's going to get you more gains from trade. I'm going to close that door because I can hear voices out there. Why is it going to get you more beneficial gains from trade? Because it's going to signal to Eric when there's an opportunity to trade at price terms that are attractive to him. He'll know that from looking at the benchmark, or he'll have a pretty good idea. And so that's going to signal to Eric when there are big opportunities for gains from trade. And when Eric finds Jose, because Eric knows something about the going price, he's going to be able to not get so price gouged by the dealer. So the terms of trade will be somewhat better than they otherwise would be. Because Jose is going to make a take it or leave it offer. And if Eric knows the going price in some average sense, he's going to be in a better position to discipline Jose's take it or leave it offer, because it's common knowledge that if Jose gives him too high a price when he wants to buy, that he'll go to one of the other dealers. Okay, so that's all coming up. It's also going to reduce Eric's search costs because of this common knowledge of the benchmark price. There's not going to be as much opportunity for Jose to leave Eric looking for a better price. So it's going to lower search costs, and it's going to more efficiently match buyers and sellers. Because if Jose happens to have a high cost for acquiring the asset, but he tries to extract a high price from Eric, in light of that, Eric can say, oh, because I know the benchmark, I realize Jose's quoting such a high price way above the benchmark because he must have high cost. There must be another dealer with low cost, so I'm going to keep searching. And that will get better matching between buyers and sellers, more efficient matching, which is another benefit of price transparency in general, not just benchmark. Moreover, there's going to be a subset of dealers with low cost. This is actually how LIBOR originated in the late 1960s. A group of banks said, you know what? In principle, maybe we shouldn't tell everybody the going price for making loans, because then we'll not be able to extract as much rents for each loan. But if we do tell the market the club price, they'll come to the club of dealers that are able to efficiently provide that price, rather than to the less efficient dealers who can't match our price. So they set up a price club in London called the London banking market. They offered the market transparency on their going price called LIBOR, and they got a lot of trade to come to the London banks because of it. Let me repeat the intuition. It's quite interesting. On an individual trading encounter, Jose would not want Eric to know the going price, because that will reduce Jose's ability to gouge Eric. But by collective action of dealers that have low cost, if they make an agreement among themselves, we're going to announce our average cost as a benchmark to the market, then everybody knows the going price. Because we're efficient, they'll all come to us, and they're not going to go to the less efficient dealers who are going to provide worse prices. And this collective action among us will draw enough volume of trade to more than overcome the lost opportunity to take rent on a given trade. Everybody get the idea of that intuition? It's very, very interesting intuition. Okay, so now that's all words. Let's talk about it in symbols. Yeah, question? Yeah, that's a great question. In our model, we only have dealers of two types, and the low-cost types are going to announce that they're going to form a benchmark club. But if we had multiple dealer types, I'm not sure what would happen. Actually, that's a great question. Nikita?
Maybe in your model, you can give the inefficient dealers the opportunity to invest in becoming efficient.
Yeah, and the best way to do that would be to become acquired, that is a merger and acquisition, and increase the sizes of the dealers. By the way, over history, the number of dealers that are making markets, that are actively making markets, has gotten smaller and smaller, and the concentration of trade among them has gotten larger and larger, kind of possibly reflecting the intuition that Nikita just gave. So in the practice, the benchmarks are the average prices at which these dealers did conduct their last round of trade. So let's say yesterday's average price among the benchmark club. And that's how LIBOR is actually set. No, it's actually this morning's price. So it's good for the whole day. But there are similar benchmarks, like the WM Reuters foreign exchange benchmark set at 4 in the afternoon, and the London gold fixing, which is set in the morning, and so on. So every major over-the-counter market, most of them have a benchmark that allows the dealers in the benchmark club to capture more trade, despite the fact that it puts them in a worse position on a one-on-one trade encounter. Okay, so here comes the model. I'm going to skip over the literature because we don't have that much time, and we're going to talk about Eric's search for one of the dealers. So here are the guys in the front row. This is José's price, $2.10. This is Elkinen's price, $1.90. Professor Maskin's price, $2.20. He's not doing too well today. He's offering very high price to buyers. We'll only do Eric is buying and the dealers are selling. And here are two other dealers over here. Could be Nobu and Yaroslava. Okay, so, but Eric doesn't know who's offering what price. He knows there's 5 dealers, and he can start searching. Okay, so these are the prices that they're posting if Eric cares to visit them. The cost to the dealers is some common cost that they know about that Eric doesn't necessarily know, plus a dealer-specific idiosyncratic cost, which in this model is either low or high. Okay? So that's the cost structure for the dealers. And now the dealers are going to price, post prices. So this José's posted price, P José, is $2.10, and so on, across the market. And what are the dealers doing? They're maximizing the rent they get on a given trade, which is the price at which José sells minus his cost, multiplied by the quantity of trade that José does. That's his objective function. And notice, again, the tension between quantity and price markup. Okay, so if José joins the benchmark club, he's probably going to have to suffer a lower markup, but he's going to end up getting more quantity of trade if he's a low-cost dealer. Yes, Idan. I'm just about to get to that. Yes, Gur. No. In this model, there's no laying off of inventory. They can produce any number of units. Yeah, but dealers do that in practice. And in fact, in this model, as in the Stahl 1989 model, it'll turn out the optimal strategy in equilibrium is for José to randomize the price that he offers to Eric. And so these are all realizations of randomized prices. Turns out to be the only equilibrium in this model. Yeah. A price only, a price per unit, and Eric is shopping for 1 unit. But this Q is then the quantity of investors that buy from José. You can think of them as producers, or you can think of them as dealers that have access to inventory, and their cost maybe in the interdealer market is this cost CI for José. Okay, so by the way, this is highly abstracted from reality. There's lots of actual considerations like inventory costs and interdealer trading that we're not going to do. Another question?
How does it incentivize for the dealers with prices lower than the public average price to actually get the price?
The dealers are not incentivized to give their true cost as a price. They want to get the highest possible markup, but they know that if they try too high a markup, they're not going to attract as much trade. And we're going to see the equations for that in just a minute. Okay. So here's, we have 2 types So we're going to take the investors, that's everybody not in the front row, and we're going to divide you into two groups. So everybody on this half of the room are really fast. You guys are hedge funds, very sophisticated. You can canvass the whole market. You've got algorithms that will search all the dealers' posted prices instantly. And you'll be able to pick the best price. So here's Nikita. He's one of the fast traders. He can enter the market at no cost, scan the entire market for all the prices, and say, oh, Eric's price is, this is not Eric. In this example, Eric's price is the lowest. I'm taking that price. This is kind of a fix on what's called the diamond paradox. Peter Diamond showed that in this kind of a search model, if you don't have some non-zero fraction of the population that's super fast, all the dealers are going to extract full monopoly rents. Very unfortunate. Now, I don't think that's actually that realistic in practice, that you need instantly fast traders, and getting around this just complicates the model. Okay, so we're going to do the diamond, we're going to overcome the diamond paradox the usual way in the literature, which is to endow some fraction of the population, which is a fraction mu of the population, with this ability to instantly canvass the market. By the way, all of you have a known value V for acquiring the asset. Okay, so you're all going to search, and you're going to accept the lowest price, provided it's below V, and that's going to be your gain from trade. Think of yourself as an investor searching. Okay, so you guys over there, no problem. You're all going to find the best price. The rest of you are going to have to incur costs for searching. Jan. It's going to be an optimal stopping problem with a very nice solution that you're going to see in just a minute, called the Pandora solution. Okay, now let's do a slow trader. Slow trader can be Idan. You don't mind being slow today? Okay, sorry. Okay, so for the slow traders, actually, we're just going to model the delay cost, which also could be an effort cost, as S per dealer encountered. Okay, so even to search one dealer, you're going to incur some search cost, and you're not required to enter the market. Actually, that turns out to be important. But if you incur a search cost, you can look at whatever dealer you like. Because it's a symmetric model, you might as well randomize, or actually we don't even need randomization, but let's say you just picked Jose first. You saw his price. You compare it to your value V, and maybe you take it, maybe you don't. We'll talk about the equilibrium in a minute. If you don't like it, you can go on to another dealer. This guy, which is Elkanan, is actually today or this moment is offering the best price. If you only knew that, you would take it. But you don't know, maybe you want to search again, and eventually at any time you like, you can stop searching and go back. And here's the trick that makes this model easy to solve. You still have the ability to go back to Elkanan and take the price that he offered. Okay? Now, there's a very few situations in which this is realistic. Normally, if you come back to Elkanan after having left him, and you say, Elkanan, I love your price, $1.90, I'll take it. Elkanan is in reality in the corporate bond market, he's going to say, you know what, Idan, I am so sorry, but the market has moved since you were here a moment ago, and now my price is higher. Okay? No, they're usually very apologetic, but they always will gouge a little bit more because Elkanan is now common knowledge between you two that Idan has visited more dealers and hasn't found any price as low as Elkanan's. Okay, this problem, which is called the recall problem, has actually been analyzed by Haoshang Zhu in another paper called Finding a Good Price in OTC Markets. It makes this model way too complicated. We're not going to do it. Okay? We talk about what it would do to this model in the paper, but we're not going to do that. We're going to endow Idan with the ability to extract the price that Elkanan posted. And one way to enforce this is to do what's called a click for trade market, in which Elkanan has no idea who's visiting his website, He can't see how many times they've come around, who they are. So he's just posting a price and hoping that people will like his price. And there are actually some markets like that, but not too many. Okay, so this is a click for trade market in which Idan will, in this scenario, he ends up choosing Elkanon, but that won't turn out to be the equilibrium. Because of the common knowledge of Idan's search strategy, it will turn out that he'll either enter the market or not, and in equilibrium, he will always buy from the first dealer that he visits, because it's common knowledge that when he visits Jose, Jose knows what his reservation price is. It's no point in Jose asking for a higher price. He'll offer a price at or below the reservation price, and Idan will instantly take it, and he won't do any more search. Okay, that's what happens in this model under certain conditions. Yeah. Spatially? Yeah. Okay, so that's a good one. Yeah, so let's say the regional banking market is a good example of that. So you want to get a loan. You could go to New York or London where the rates are better, but your search costs for going to New York or London are higher, so you stay in Cincinnati and you call your local regional bank. And then the regional bank will offer you a loan, possibly at worse price terms in light of your search costs. And then the regional bank in Cincinnati may lay off the position at a New York bank, et cetera, et cetera. So that's a much more realistic model. We're not going to do that. This is more like an electronic global market like for foreign exchange. Any other questions? Yeah. We have 10 minutes, so I'm not going to get through the whole thing, but I'll do whatever I can.
Why can't the fast traders make a profit by selling everyone the price?
Well, because they're doing other things today. You know, they're attending courses in Jerusalem, and they're not in the business of providing price transparency. But in practice, there are firms like Bloomberg and Reuters that do make a business of canvassing transactions prices and reporting them to the market. And the dealers don't really like that very much unless they can do the club thing with a benchmark. So that's a real effect that you just described. So there's lots of industrial organization going on in this market, and one of the parts of it is how to add price transparency. It's a great question. Any questions about, this is Idan's opportunity here to search. Okay, now let's do the equilibrium for this model, and we won't be able to do all the properties, but some of them. So here's an outline. We're going to be able to compare the welfare of the market with the benchmark price transparency and without. Not under every condition. I'm going to, if we have time, I'll explain some exceptions, but under plausible conditions, because it reduces the holdup problem. If you have a benchmark, welfare will be higher with a benchmark. With heterogeneous costs, benchmark will improve matching efficiency. I already described that. There are conditions under which the dealers want to have price transparency as a pre-commitment. Even though it reduces their price gains on each trade, it increases the volume of trade enough to overcome that. And it turns out that whenever the dealers want to have a benchmark, that improves welfare, but the converse is not true. When the dealers don't want to have a benchmark, it may still be welfare optimal to have a benchmark. The benchmark club, like the London banks, may have an incentive to distinguish themselves if they have low cost by revealing their average cost to the market. Again, a pre-commitment device to get to concentrate market share on the club and to drive out the high-cost dealers. So that's actually an improvement in welfare associated with benchmarks. It creates more efficiency in the dealer market. And we're not going to talk about, although we do in our paper, manipulation incentives. Okay, so that's outline of results. Now let's do the equilibrium. First we'll do the equilibrium search strategy and then the equilibrium itself. So Idan's search strategy in equilibrium is to enter the market if it's valuable enough to enter, to calculate Idan's reservation price, and to keep searching until the value of searching one more time is worth it, and it turns out to be to set the reservation price and then to keep going until you find a dealer that's offering a price at or below the reservation price. Yes, a question? Yes, It still exists. Yeah, you can't get rid of it that easily. It's a really annoying problem. The plausible case is to have a continuum of speeds, and that will do it, but that's a real mess. I'm going to skip over this stuff and go directly to José's calculation of what price to offer. Okay, so here's some calculations that José has to do when he's approached by somebody. He's not sure it's Eric. He's not sure whether it's a fast trader like Eric or a slow trader like Idan. He's going to do some calculations to set his price. The first thing he's going to do is to calculate what's the probability that whoever is my next visitor is a fast trader. Okay, that probability will be useful information. Let's calculate it. First, based on the cost which José knows, and in this example that we have, I'm only going to have time to do the case where the benchmark is a published benchmark. Okay, so the cost of dealers is published. It's a benchmark. José knows that, Idan knows that, and that means that the fraction lambda c of slow investors that enter the market is common knowledge and depends on that benchmark. Okay, so that's an important calculation. We haven't calculated lambda c yet. We're going to. It's an equilibrium probability of entry into the market by Idan. Okay? Based on that, we can calculate the fraction of fast traders in the market, which is the total mass mu of fast traders divided by the total mass of traders that enter the market and whose first visit is to José's website. Okay, what's the mass of traders that enters the market? It's the fast traders plus the slow traders that get to José. José is 1 over n of the dealers, so he only gets 1 over those that enter. Lambda c is the fraction that enter, and this is the total mass of slow traders. Now, I know that was a bit quick, but let me just repeat. This is the probability that José is facing a fast trader, which is the mass of fast traders divided by the total mass of traders that get to his website. By the way, I give this as a homework problem to my students, and with some variations on the problem, this is the part that messes up a lot of people, which is what's the probability of getting to José's website? And as you change the model design, that probability will change. Here it's just 1 over n because there's n traders, and Idan can't do any better than randomize, so he has a 1 over nth chance of visiting José first. Idan? There is a? Yeah, it turns out not to matter because it will always turn out by symmetry that even if you don't randomize, 1 over n of the slow traders who enter, that fraction will choose José first. Another 1 over n will choose Elmen first, and so on, where n is the number of dealers.
But then, if I know that only this n approach me, then I'm not going to touch anyone else. Why wouldn't I pick the higher price?
We're going to calculate the price based on the equilibrium with this fraction of fast traders facing José. Maybe I should jump ahead because I only have 5 minutes and I want to show you the key equation, which is the next one down.
You might not want to take the question later. You seem to be exploiting the anonymity
I am.
a lot. Because if I were a fast trader, I probably wouldn't know that. And by a way of doing that, I would.
Yeah, definitely. And this is a click for trade market in which José just puts a price on his website and closes his eyes and hopes for the best in terms of who comes to his website. But if he knew who were coming, that's why this is not as good as the recall design that Haoshang does, which is much more difficult to solve. Okay, so if we get through the next equation, which is really due to Stahl, this is an updating of the Stahl 1989 equation for how José sets his price, we will have accomplished what I most want you to understand, which is how the equilibrium offering prices are being set in this kind of a model, okay? Unfortunately, we're not going to be able to do Weitzman's very clever solution of the optimal search strategy. We're going to run out of time before we get to that. But there's an Econometrica paper showing how this optimal stopping problem for Idan is solved. And I'm just going to have to refer you to Weitzman's work and then see how it's applied another time. But I do want to get this pricing equation because it's the key insight, okay, of how prices are set in a dealer-based market where you have this anonymity situation. Okay, so here's, once Jose has calculated the probability that he's facing a fast trader, he needs to know what price to set. It turns out the unique equilibrium in this model and in all of this family of models going back quite a long ways into the 1980s is randomization with no atoms. That is, no point in the price support has strictly positive probability. Jose is going to smear the probabilities across an interval of prices with no atoms at any one price. And what he's going to do is, since he's randomizing over different prices, he must be making equal profit conditional on drawing any price in that interval. Why? Because if he weren't making equal profit, and he was making, let's say, a slightly lower profit at one of those prices, he would take it out of the support and say, well, I'm not going to offer any probability on that price because that's a lower profit price. And if you were making strictly higher profit on some point in the price support, he would say, oh, I'm going to concentrate more mass on that price and keep doing that until I've equated my profit across all the prices in the support of my price distribution. So that's the trick that's used in this literature to calculate the equilibrium price offers. And here's the equation that does it. First of all, later, which we're not going to do today, we're going to be able to calculate using the Weitzman Pandora solution Idan's reservation price, the highest price that he's willing to accept as a buyer. Now we calculate Jose's profit in the event that the price that he offers is at the very highest price support that Jose is willing to make, which is Idan's reservation price. He wouldn't offer any higher price because he's never going to get Idan to accept it by definition. So the highest profit margin that Jose can get is Idan's reservation price minus his cost. This is the mass of traders that are going to be willing to take this high price. Why? Because this is the mass of slow traders. Why wouldn't a fast trader take this price? Somebody. Why wouldn't a fast trader take Idan's reservation price? Because it's the absolute top of the distribution, and a fast trader can canvass the whole market, and with probability 1, there's going to be a lower price somewhere in the market. Okay, so only slow traders will accept that price. So that's Jose's total mean profit associated with drawing the highest price P equal to Idan's reservation price. And we just said a minute ago that the expected profit at any point in the price support must be the same as any other point. Let's calculate the price at some other arbitrary, let's calculate the profit at another arbitrary price P. Okay, so the other arbitrary price P has a profit margin for Jose of the price at which he sells minus his cost. And now all we have to do is calculate the expected volume of trade at that price, or equally the probability that the price will be accepted by the guy that's visiting. And let's do that. First of all, this is the mass of slow traders that are getting to Jose. They're all going to take that price. Why? Why are they all going to take a price P in the support of Jose's price distribution? Easy one. Gregor. Right. They were willing to take RC. They're certainly willing to take a price below RC. So Jose's going to clean up on all of those guys. He's going to get every one of them to trade. Now Jose is thinking, but what about the fast traders like Eric? Will they accept the price P? Let's calculate the probability that they do. First of all, here's the mass of fast traders, or the probability that I'm facing a fast trader. Same thing. So I'm going to be facing them, but they might not take the price P. What's the probability that they take the price P? Yes. It's the probability that Jose happens to draw P as the best price among all the dealers. Okay? Now, note that Jose is not able to strategically observe the other dealer prices and choose accordingly. It's a simultaneous move game, or is some cost to Jose for checking the other prices. So he's picking this price and he's hoping that if it's Eric who's fast, that he happens to get the best price. He's posting the best price among all the dealers, and the probability of that happening is 1 minus the probability that the other dealers' prices are worse or higher, all of them. And so that's the total probability that he's going to conduct a trade at the price P. Here's his profit margin. It must be the same as his profit margin at the top of his support. Now we have an equation for P, which has a closed form solution with two missing parameters. Two missing parameters, which I'm not going to have a time to calculate, but there's a closed form solution for those as well. One parameter is Edon's reservation price. And we're going to use the Pandora solution to calculate that. That's the optimal stopping problem that goes with this. And the other constant we don't know is what fraction of the slow traders will actually find it worthwhile to enter the market. And that's another kind of market clearing equation, which we're not going to have time to do today. But you solve those step by step. First solve RC given lambda C, then solve lambda C. Everything is closed form. And you calculate the price distribution. And then you do everything again with no benchmark price transparency. And you compare the expected welfare gain in each case. And you do all the other things that I promised, which I'm not going to go through, which are improved matching efficiency, the dealer benchmark club effects, the lower search cost effects, et cetera, et cetera. And some interesting things happen, but that's as much as we have time for today. I actually am a few minutes over time. Yeah, Eric.
The typo there, cumulative goes right after F.
After. Right.
1 minus F is the quantity. Everyone else is the product.
So this is the probability that they're below, and that's the probability that they're, oh yeah, it's 1 minus F of P all to the n minus 1. Thank you. Good catch. Yes? There's some very counterintuitive things that happen in the Stahl 1989 paper itself about what happens as you let n go to infinity. And in the interest of time, I'm going to discuss that offline. Those counterintuitive things, I think, are an artifact of the way that Stahl set up his model, and there's a way to get around that that I've discovered recently that maybe you'll be interested in pursuing. Okay, so we have to stop now, unfortunately. Thank you so much for the opportunity to talk to you. And I'm going to sit down and listen to Nobu next.